This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Welcome to episode 249. Recording this on an unbelievably beautiful day in Ottawa. 1 week after this terrible ice storm we got between here and Montreal that wiped out power for a lot of people. I know, Ben, you were without power, but today it's like 28 degrees and crystal clear sunshine. It's beautiful out. Anyways, in this week's program, you are going to answer the question, I can't wait for the answer, what are financial advisors useful for? I'm going to do a quick summary of episode 43 when I sat down with co-CEO of Dimensional Fund Advisors, Dave Butler. And then our colleague Lukas Fleck is going to join us, and we're going to review Ryan Holiday's book, The Obstacle is the Way. And then we're going to talk about Lukas's reading hacks and also our company book club. And of course, we have the Aftershow where three people join us to talk about this and that, including the ever-heated debate of hot sauces, Ben. Yes, come for Ben's deep dives into stuff financial, but you stay for the hot sauce.
You joke, but people really do stick around for the
I know, and people also take hot sauce unbelievably serious. So I have to up my hot sauce game because I kind of got caught in the crossfire on this one unintentionally. So we'll talk about that. Want to try to increase the audience of the podcast. I think that's a reasonable objective we should all have. I think a lot of this content is worthwhile for a lot of people. I especially highlight a lot of the guests we've had. So if everyone who listens to this shares it with one person, I think collectively we can make a difference. That doesn't seem like that big a request, so that'd be awesome. And also, if you're a Canadian that happens to be looking for a great advisor to work with to plan and manage your serious long-term money, reach out. We have an unbelievable team of advisors, and we'd be happy to speak with any Canadian who might be interested.
It's true, though. Our podcast audience has been like growing much more slowly than it did at first. It grew a lot, really fast, and it's been stable, which is nice. But the rate of growth definitely changed over the last, year.
Yeah, it's not a complaint. It's just there's such great content that so many people could benefit from. Like, pick an episode, Charlie Ellis, right? Applicable to millions of people, or Ken French, or Gene Fama, or go down the list, right? There's been so many great people. So it'd be great if you could share it.
Yep, I think that's a good request. I think I say that at the end of all of my YouTube videos too, don't I? If you found this useful, share it with someone who,
Share it. Just share it. Anything to add, Ben?
Nope.
All right, let's go at episode 249.
Welcome to episode 249 of the Rational Reminder Podcast.
All right, you've had your snack. Oscar's asleep, so we're all ready for the big feature.
Yeah, hopefully it's good. I don't know. I wrote this, but haven't actually read it yet. So I'm going to be like you, hearing it for the first time.
It's funny. We later in the program we talked to our colleague Lukas, so we got a chance to see how the sausage is made, which was kind of funny.
Lucas got to see the behind the scenes of the podcast. Yeah,
behind the scenes. There's, as we say, there's a whole lot of duct tape that goes on behind the scenes.
Lots of duct tape. Anyway, so the main topic that I have prepared here is, and this is part of the advanced basics, as we've been calling it, curriculum, which is it's a literal curriculum that I've created, which we'll use for other stuff later. But this is I jumped ahead. This is the very last topic in the curriculum. There are a couple more that we're going to have to go and backfill. But I've been doing a bunch of reading about this topic, so I wrote it because it was part of the things I wanted to write anyway. Anyway, the topic is, what are financial advisors useful for? Why did you make that face?
We pretty much built our careers on this, so I'm dying to know the answer. Devoted 32 years of my life to this.
Yeah, and we did one episode a while ago on what is good financial advice, and we talked about some of this stuff, but we also talked about other stuff like goal formation, which is not in here, And it's not in here because that's not something that has been, from what I could find, that's been researched in an academic way.
Oh, wow.
There's one paper that I found that was it was okay, but I don't know. It wasn't. The findings weren't robust enough where I was like, yes, I should include this. But that's hard to study. Like, how do you study that? I don't know. I don't know how you would even structure that. If anyone's listening and has research on the relationship between goal setting and financial advisors, I'd love to see it, but I couldn't find it. So what I've done here is focused on the things that are theoretically and empirically robust and published in top financial economics journals, not smaller journals focused on financial planning, which have a tendency to be more practitioner, industry focused, and maybe biased.
Interesting.
So I want to step back from that and not talk about studies that show, people with higher net worths have financial advisors, because those studies don't make sense. There's lots of those. Anyway, so this is I tried to find stuff that was more rigorous than that.
What a great setup.
I'll get into it. So, as our listeners likely know, it's increasingly common knowledge that low-cost index funds have effectively solved investing for most people. And I kind of say that as a joke because, as anybody in the Rational Reminder community knows, who spends many hours of a day discussing the optimal portfolio, there's still lots of decisions to be made when it comes to investing. But using low-cost index funds is a pretty good solution for most people. So I think we can say, somewhat tongue-in-cheek, that investing has been solved.
And that is a big, bold statement that's inside the Random Walk book by Burton Malkiel. I was reading it last night again to prepare for our interview with him. And that's exactly what he says. And that book is 50 years old.
Yeah. Yeah. Well, yeah, we saw that with Charlie Ellis too. Like, there are people that were making that call decades ago, but I think it's becoming increasingly common knowledge today. So in that environment, the question that I wanted to answer is, or the question that I think lots of people might have is, what value are financial advisors providing if it's not beating the market or selecting investments? If we take it as a given that investing has been solved, that implementing a portfolio has been solved, what is it that the financial advisors are doing? Now, I think asking that question is important for consumers because it tells them what they should be demanding from a financial advisor. And I think it's important for financial advisors because they need to know where to focus their time. So I think, in theory, financial advice is useful because personal finance decisions are complex, and common rules of thumb often give incorrect answers. We've talked about that many times. And many households are financially illiterate. So you take complexity, rules of thumb that give wrong answers, and financial illiteracy, and you can see why, in theory, an impartial, unconflicted, competent financial advisor, and all those qualifiers, we'll see why they're funny in a bit. But you can see why theoretically that would be a great solution if you could just plug that unbiased advice and expertise into all of these complex decisions and financially illiterate households. Of course, that would make sense as a solution. The other problem is that financial products themselves are extremely complex. And there's a bunch of really interesting research, theoretical research and empirical research showing or suggesting that financial products are intentionally complex. The idea behind that research is that financial product manufacturers intentionally increase product complexity to shroud prices, like to make it more difficult to the consumer how much they're actually paying to buy the product. And that prevents some consumers from becoming knowledgeable about prices, which allows the product manufacturer to maintain much higher margins than they would if all consumers knew about prices. There's some pretty cool papers on that from the early 2000s on that theoretical thinking. And then in the financial product landscape specifically, there's been really interesting empirical work showing that that is in fact happening, which I mean, like, of course it is. We know that as people who see financial products all the time, but consumers don't necessarily know that, which is exactly the point.
The focus is often on the story, not on the costs. People love to make buying decisions based on the stories.
For sure. And I mean, like the prime example of that is probably structured products. And that's where some of the interesting empirical work has been done, where you've got these extremely complex products where the costs are just totally opaque. Maybe insurance contracts can fall into that category too, where it's just really hard to know what you're paying and it costs.
Yep.
And so it's hard to assess alternatives. It's hard, anyway. Now, if that weren't enough, so we've got the complexity of the decisions, the complexity of the products, we've got financial illiteracy, and then the other big issues are that households have cognitive and behavioral biases. Households tend to incorrectly assess the effects of compounding.
Mm-hmm.
They tend to prefer smaller rewards now to larger ones later.
Mm-hmm.
That's exponential growth bias and present bias. And add that on to the complexity stuff I was just saying of products. Those biases and other ones may be exploited through contract design and good old-fashioned manipulation and deception. And I had my source for the manipulation and deception is Robert Schiller's 2015 book, Fishing for Fools. It's got a whole book on that. So given the challenges that households face in making good financial decisions, it should not be a surprise that they often make costly mistakes. And we get some of this from John Campbell coming up next week too. That's possibly why I had my head in this topic. Mm-hmm. That's definitely why, actually. I had a bunch of tabs open from preparing for that conversation, and I just went from there.
And
we talked about some of this.
That conversation is not to be missed.
Yeah, that's an incredible episode. Yeah. Not to diminish how incredible many of our past episodes are, but that one's unreal.
Yes.
Okay. So the mistakes that households make, and these are all statements based on research. Like each statement is linked to at least one study. So households often invest in high fee funds, even when otherwise identical lower fee options are available. That one's fascinating. They look at S&P 500 funds, and it's like, why do households not invest in the lowest fee S&P 500 fund? It's a great question. They fail to refinance their mortgages when it would be beneficial to do so. They under-diversify their portfolios or fail to participate in the stock market altogether. They engage in attention-induced trading. They overinvest in their employer's stock, particularly if that stock has performed well in the past. They fail to contribute to retirement plans with employer matches, even when they can take the money out with no penalty. They undersave for retirement, and they under-annuitize their assets in retirement. That's not an exhaustive list of mistakes that households make, but it's a bunch of pretty interesting ones that I think we've talked about before at various points in the podcast. Now, you look at that or you hear that, and again, like I said earlier, it seems like financial advice should just be the solution. You get a good advisor in there and they fix all that up. But it's much more complicated than that, unfortunately. Financial advisors often have conflicts of interest with their clients, and some are more conflicted than others, depending on how they earn their compensation. In some samples, financial advisors fail to de-bias their clients. So we've got these biases that are an issue that I was talking about earlier. But in some samples, advisors fail to correct for those and may even reinforce the client's biases if the bias is in the interests of the advisor. Like if it's good for a client to chase returns, or if it's a good for a client to prefer actively managed funds, then the advisor will. And this is based on I can't remember what the word is for it. It's research where they take somebody and put them in the shoes of a client and have them go talk with advisors.
Or like a blind shopper.
Yeah, it's like that, but there's an actual name for that approach to, anyway. I can't remember what it's called, but so that's where that finding came from. So they actually encourage biases in some cases. If a client comes in with a portfolio of index funds and asks for advice, advisors who earn commissions will push them toward actively managed funds. So not ideal, at least in that sample. In another sample of life insurance agents in India, the agents overwhelmingly recommend products that pay them high commissions while being suboptimal for the clients. And they cater to the beliefs of uninformed consumers, even when those beliefs are incorrect. And they seem to focus on maximizing their commissions as opposed to focusing on how much insurance coverage their customers need. So like obvious conflicts of interest, unmitigated conflicts of interest. So not surprisingly, there's evidence that placing higher standards on the requirement for advisors to act in their clients' interests as opposed to their own does improve outcomes. There's one study using state-level variation in fiduciary duty. This was for annuities. And they find that the existence of a fiduciary duty increases risk-adjusted returns for clients by 25 basis points, largely due to raising the bar on advice. There's another study that shows that the sales of higher fee products that pay high commissions, this was again based on annuities, are 4 times as sensitive to brokers' interests as to investors. That's crazy. Did you hear that? Sales of higher fee products that pay commissions are 4 times as sensitive to brokers' interests as to investors. That's wild. And then after the U.S. Department of Labor proposed a rule in 2016 holding brokers to a fiduciary standard, sales of high expense annuity products fell by 52%.
Wow.
As sales became more sensitive to expenses and investor welfare improved.
Wow.
Yeah. Incentives matter, and I guess regulation matters as well. Now there's another study that I didn't write notes on it, but it was another study in the Indian market where there's a similar thing. There was a similar shock to the market that they were able to look at, and in that case, the agents shifted to a different type of product. I don't remember what the details were in that study, but it reminded me of in Canada, we ban deferred sales charges on mutual funds, and then we see deferred sales charges on segregated funds increase. Seemed like the same kind of setup.
Kind of like the whack-a-mole game.
Yeah, exactly. Now, I think it's interesting that theoretical research suggests that if consumers are aware of advisors' conflicts of interest, advisors are incentivized to learn which specialized product best meets the client's specific needs, which can actually be good for consumer welfare. So the commission model isn't objectively bad if consumers are informed, is basically what that is saying. But if clients are naive and believe that the advisor is offering them unbiased advice when in fact they're not, in that setup, commission-based compensation may be used to exploit their naivety. And I think that's more realistically what we tend to see in real life. And it's probably related back to the earlier comment about households being largely financially illiterate. Not largely, that's not quite fair. In many cases, households are financially literate or have low financial literacy. Likely related to that, bank financial advisors in one sample. This is a paper in the Review of Financial Studies. They're found to recommend the bank's own mutual funds and structured products to the detriment of their clients. It's crazy how much research has been done on conflicts of interest in financial markets.
I would add to that, it's crazy the amount of research has gone into this work. Like the number of references you have in here and the names of these authors is nuts. Like the body of work that is cited in this summary is unreal.
Yeah, well, that's what I said. I was trying to do a rigorous overview of the topic.
You have 32 references.
Yeah.
And like the who's who of academics.
Yeah.
That I recognize. I know. There's so much more.
I wanted to, because it's so easy to find like industry publications or whatever on the value of advice or subjective evaluations of the value of financial advice, but I kind of wanted to find like, Journal of Finance and Journal of Financial Economics and Review of Financial Studies level research that had looked at these topics, and it's out there. Okay, so there's these conflicts of interest. It's kind of, so where are we? I mean, like I said at the beginning, I'm hearing this for the first time too, because even though I wrote it, I haven't actually read through it yet. But let's think about where we are right now. Households make a lot of financial mistakes because financial decisions are complex, financial products are complex, households have biases. You would think financial advisors could be a good solution to that, but so far where we're at is that there are a lot of conflicts of interest that affect the quality of that advice and maybe even make it detrimental. Now there's another paper that we've talked about a few times on the podcast, which looks at the beliefs of financial advisors. So it kind of tries to isolate for conflicts of interest by looking at what the financial advisors do in their own accounts. If there's a conflict of interest, the financial advisor might be owning index funds in their own account and then selling high fee actively managed funds to their clients. But empirically, and this is the study, the misguided beliefs of financial advisors that people might be familiar with, in the Journal of Finance, they find that financial advisors trade frequently, chase in this specific sample. It's not necessarily representative of all financial advisors, obviously. But in this sample, they trade frequently, they chase returns, they prefer expensive actively managed mutual funds, they under-diversify, and one of the most interesting parts of the study is that they continue making these mistakes after they left the financial services industry. Because one of the counterpoints could be, oh, well, they're just doing that so that their clients think that it's good because the advisor is doing the same thing. But then as soon as they leave the industry, they'll go buy index funds, but they don't. They keep making the same mistakes.
Fascinating.
Yeah. So this one's just suggesting that even if we solve conflicts of interest, it doesn't necessarily solve the problem of advisor competence. I know that all I've talked about is like the bad, why are financial advisors not useful, but I will get to why they are useful or where they're useful, at least in this research that I found. One other thing on the misguided beliefs of financial advisors, that last time we talked about this, someone pointed this out, I think in a YouTube comment or something. The finding that advisors in this sample behave that way, and that's why I emphasize in this sample, it could show that advisors, that it's representative of biases that advisors have, or it could show that the firms, because this was based on, I think, 2 different Canadian financial institutions, this research, it could show that those firms specifically select advisors who will deliver sincere but misguided advice to clients. So the firms could be going out looking for people who, and like, hey, we do this too, just in a different way, but we go and look for advisors who are aligned with our investment philosophy and our belief system. So we want people that want to eliminate conflicts of interest or reduce conflicts of interest and recommend low-cost investments and all that kind of stuff. But these financial institutions could be recruiting people to do the opposite. So it could be an extremely biased sample and not at all representative. So that is important to point out. In another Canadian sample, financial advisors exert substantial influence over their clients' asset allocations, but provide limited customization for client attributes like risk tolerance, age, investment horizon, financial sophistication, and they charge high fees for doing so. So that's another potential issue, is there's conflicts of interest, there's potential incompetence, and then there's potential lack of customization. Like if there's a very cookie cutter approach where advisors are giving everyone the exact same portfolio and calling it financial advice, that could also be suboptimal for investors. So the evidence so far suggests that financial advice is often low quality due to conflicts of interest, misguided beliefs, and a lack of customization. Despite this, and this is what I find interesting, we know that these problems exist, but despite this, people still seek financial advice. So there's got to be a reason. I read in one of John Cochran's papers a long time ago that when you see the market doing something, you can say that people are just stupid, or you can ask why that's happening. We talked to Will Getzman about this too. He talked about home country bias when that came up, and he talked about how people have been saying for years this is a mistake, but hey, maybe there's actually some logic to this. So that's kind of what I had in my mind when I was going through this. Why are people still seeking financial advice despite all of the issues that we know exist? There's a few reasons. In one study of German brokerage clients, investors with self-control issues, and this is a really interesting instrument that they used to measure that, they took people who smoked cigarettes and said they have self-control issues. And I'll elaborate on that in a second. So they found people with self-control issues measured by smoking cigarettes are more likely to delegate their decisions to financial advisors, which work, in this case, like a commitment device. And even with advisor incentives, overtrading for these investors is reduced, investment biases are mitigated, and performance is improved.
Wow, that's fascinating.
So we take a sample of investors who would have made themselves worse off, and in that case, the financial advisor serves as a commitment device and mitigates their self-control issues. Now, on that smoking thing, because I kind of read that, I was like, really? Is that a good instrument to measure? So there's another paper by the same author where they basically proved that or showed it empirically that smokers do have self-control issues in financial decision-making. They trade more impulsively, and their lower self-control exacerbates existing investment biases. So that's a separate paper. And then they did another paper looking at how financial advisors affect that. Investors who exhibit the exponential growth bias, so that's the bias that interprets compound functions as linear and causes all sorts of problems with long-term decision-making. They, in this sample, this is a paper in the Journal of Finance, they seek more outside financial advice. And those biased households or biased investors who do get advice are just as wealthy as the least biased households. But biased households who don't get advice are less wealthy. Investors may additionally benefit from trust. This is a theoretical paper in the Journal of Finance. They may benefit from trust to the extent that having a trusted advisor reduces the perceived riskiness of investments and allows risk-averse investors to own higher expected return assets than they would have otherwise owned on their own. I think that one's pretty interesting. That paper's called Money Doctors, which is kind of a funny title. Consistent with what that paper puts forward theoretically, there's a lot of Canadian research here, but there's more research on a Canadian financial advisor sample that shows that advisors do influence savings behavior, they do influence risky asset holdings, and they influence trading activity. So the authors of that paper suggest that financial planning benefits may explain investors' willingness to pay high fees for advice. So that's kind of in line with the de-biasing that shows up in some samples, and and the trust allowing for greater equity allocation. Financial advisors, they increase stock market participation and risk taking and decrease investments in cash accounts. This is another paper. And longer advisor-client relationships, which this paper says is a proxy for trust, increases clients' willingness to take risk and to stick with their investments after market declines. So there's the de-biasing, there's the increasing self-control of a financial advisor as a commitment device. There's the de-biasing, the exponential growth bias, which I find really interesting because that's like That's what financial planning, the process of financial planning or of doing long-term projections is like a process of debiasing exponential growth bias, because it's we talked about this with Eric Johnson. If you give someone the number instead of saying this number compounded for 40 years, just give them the end result. It's a lot easier to think about. And that's exactly what financial planning projections do.
Yeah.
They by their nature, they debias for exponential growth bias. And then we have trust, which increases risky asset exposure. Okay, and then the last one, this is a paper from the Journal of Financial Economics. They look at a life cycle model that incorporates the fact that investors have to forego acquiring job-specific skills when they spend time managing their money, and their efficiency in financial decision-making varies with age. So they say that there's a cognitive decline over time that makes it more challenging to make financial decisions. And I don't think most people would agree with that or would disagree with that. I think that's pretty a pretty reasonable assumption to make. And we hear that all the time, that, when I get older, I'll probably hire a financial advisor. So they show that the demand for delegation of financial management is going to vary with the opportunity cost of time. And it's super intuitive when you think about it. It's going to vary with the opportunity cost of time. So if someone has a very high opportunity cost of time, they'll be more likely to delegate. And it varies with age and cognitive ability. So as people get older, they made a really interesting point actually in that paper. As people get older and the cognitive load of financial decisions increases, the other thing that happens is the opportunity cost of time also increases because their life expectancy decreases. That's at least what they're suggesting in the paper is what's going on. And then the level of financial wealth is the other interaction. And the level of financial wealth matters in their model because fees are relative to, it's like a percentage of assets type situation. So in their model, consumer welfare is improved by the availability of delegated management, but the model does assume that financial advisors always act in the best interest of clients. So we're kind of back to that topic. In addition to that, and this is moving on to other research now, delegation can have benefits in removing stress and mental overhead. So there's one paper that looks at a decision delegation when the decision affects other people. People are more likely to delegate decisions when they affect more than just themselves. And again, just totally anecdotally, that's something that we've certainly seen where there may be a spouse in a relationship who's perfectly capable of managing the family's wealth, but because they have a spouse who they're also making decisions on behalf of, they decide that they're not comfortable holding that full burden. And the last one on that is that expert financial advice neurobiologically offloads financial decision making. So the actual firing in the brain required to make financial decisions about lottery payoffs turns off when people defer to an expert. So in terms of like actually reducing your cognitive load, that appears to be a thing too. So to summarize all that, despite conflicts of interest and often suboptimal advice, households benefit, like despite that, I think that's important. We know these issues exist, but in the face of those, households can still benefit theoretically and empirically from an increase in self-control, a reduction in biases that affect long-term decision-making, and higher equity market participation due to trust in an advisor. And investors with a high opportunity cost of time or declining cognitive ability theoretically derive benefits from delegated advice. Now, if we remove conflicts of interest and control for advisor competence, I think that there's a pretty good case for financial advice for some households. It's a big problem, though, that there's a lot of, and this is a regulation issue, I think. There's a ton of heterogeneity in financial advisor quality and compensation models. So that poses a problem because people still need to be able to identify the need for advice and assess the quality and incentives of an advisor for them to be most useful. Like as we've seen, even when there are conflicts, and even when advisors aren't perfectly competent, they can still be useful. But I think it's fairly obvious that they're much more useful if we can control for those things or remove those variables. And a couple other interesting obstacles, I guess, it's the Dunning-Kruger effect. People with inflated perceptions of their own financial literacy are more likely to make mistakes and less willing to accept financial advice. So that's interesting. And more knowledgeable investors are more likely to seek and benefit from financial advice, which is also interesting. Less financially literate consumers are less likely to seek financial advice. There's all sorts of interactions there, like they may have less wealth, for example, but still interesting. As super simple rules to follow, I think that investors can avoid advice that's associated with a commission, which means what questions should you ask if you're going to be getting financial advice from someone? And we've said this before. You have to know how they're being paid. You have to know what the advisor's incentive is and to what extent it aligns with your own. And I think you have to demand commitment to a fiduciary standard or some similar level of commitment. And there are all kinds of different ways to approach that, I guess. Like in Canada, we have the portfolio manager registration category, which implies that level of commitment. But then there are also like people who are CFP professionals and people who are CFA charter holders. They commit to that level of a standard. But I think that the hard part is one of those last points that I made, is that like the people who would probably benefit from financial advice the most are less likely to seek it out. You have to have a baseline level of financial literacy to know that you need advice, to know to know what you don't know,
right,
and to benefit from the financial advice that you receive. So that's I don't know if financial advice solves the need for financial literacy. I think that there's still a need for people to educate themselves. But given that, I think financial advice does have some interesting qualities in debiasing, acting as a commitment device, building savings plans, and yeah, I guess that's it. This is a quick addendum that I'm recording the day after we recorded the episode, but I kept researching the topic today, and there was a bunch more good stuff that I didn't have in my notes when we recorded the episode, and I just felt it was worthwhile to add them now. On household mistakes, a couple of other important ones are that investors often anchor their beliefs on their personal experience rather than broader historical context. And they overinsure small risks like buying extended warranties, while underinsuring large ones like purchasing adequate life insurance or purchasing annuities, which we did mention in the episode, just not in that exact context. That's one that John Campbell talks about too, and when we talk to him in the episode next week, is that exactly that households underinsure large risks and overinsure small risks. There's also some more interesting stuff that I wanted to touch on the impact of financial advice on investor portfolios. In a U.S. sample, the portfolios of households receiving financial advice on their retirement accounts have higher international equity exposure. In another U.S. sample, retirement plan participants who are predicted to seek advice based on their low financial sophistication, who do seek advice. So there's households who are predicted to seek advice. Of those households, the ones that do seek advice from a conflicted broker have higher equity allocations than those who do not get advice, that were predicted to get advice but did not get advice. So this study suggests that there is value even in conflicted advice through greater risk taking, which is, of course, something that we talked about in the episode. But when a target date fund is made available through this plan as a default option, the advised households earn lower risk-adjusted returns related to the high commissions that they're paying. So it's like when cash is the default, the alternative, having even conflicted advice is good, is kind of the premise of the paper. But as soon as you introduce a low-cost target date fund as an alternative, the conflicted advice looks like it's not so good. In a Dutch sample, investors with low financial capability see improvements in diversification when they receive financial advice. In another Dutch study, it shows that advised portfolios are more diversified and have less idiosyncratic risk compared to self-directed investors, but they show no difference in risk-adjusted returns. In a German sample, it shows that advised households perform worse, partially due to higher trading costs and more turnover, which is consistent in that sample with commissions being the main source of advisor income. We mentioned self-control during the episode. Another study of German investors finds that financial advice improves saving behavior, particularly for households with low self-control, and increases the ratio of stock market share of equity allocation in total financial assets. So there's that point coming up again. Underinsured on life insurance is one of the mistakes that I just mentioned. And on that topic, there's a study of American consumers, which finds that those with a financial planner are more likely to have adequate life insurance than those with no planner. And then the last one, and I know I mentioned during the episode that I didn't find much research on goals, and this one doesn't really try and quantify those types of benefits. But it does. It's a large sample of university employees, and it finds that working with a financial advisor is related to the act of goal setting. So it's not trying to say that they're getting better outcomes by nature of doing that, but it is just saying that they're more likely to set goals. It's also related to the calculation of retirement needs, retirement account diversification, the use of supplemental retirement accounts, accumulation of emergency funds, positive behavioral responses to an economic crisis that they had in their sample period, and retirement confidence. So I'm just going to summarize real quick again. Hopefully it's not too repetitive, but I added quite a few points. So the benefit of financial advice is probably not beating the market, no surprise, especially with low-cost index fund portfolios being readily available to investors today, kind of like the target date fund example in that one study. Consistent with, of course, trying to beat the market being a losing game. I don't think it makes sense to expect that financial advisors are going to add value to portfolio returns, which is exactly what we see. We do see, though, across multiple samples, that financial advisors do seem to improve portfolio diversification and increase the equity share in portfolios, which is only beneficial as long as fees are low, because extremely high fees can completely eat away any benefits of a higher equity share. Portfolios aside, financial advisors do seem to act as a commitment device, increasing self-control, particularly for households with poor self-control. For biased households, they mitigate biases that affect long-term decision-making, like the exponential growth bias, and they influence more adequate life insurance coverage than households who either work with a broker as opposed to a financial planner or who don't have any advice. Investors with a high opportunity cost of time or declining cognitive ability benefit more by delegating financial advice and management, assuming that the financial advice is in their best interest. And that, of course, keeps coming up. And then delegation may have other benefits like offloading responsibility when decisions affect other people and reducing mental overhead. All right, that's it for the addendum. I'll let you get back to the episode.
I'll go out on a limb and say that was one of your finest deep dives.
Really?
Absolutely. I thought that kind of wraps up so many concepts and ideas and is very useful to the end consumer. 100%.
Well, I'm glad to hear it.
And maybe we'll get feedback that agrees or disagrees with
This was
your
the
work
worst
and my
episode
assessment.
ever. I want my money back.
All right. Did you want to go to the quick review of a past episode?
Yep.
All right. As people know, this is where newer listeners can learn about a past episode that they may want to check out. So I'll give a bit of a backstory. 4 years ago, almost to the day, I think, I was invited
That was 4 years ago.
4 years ago. Yeah, 4 years ago, I was invited to a conference in Sydney, Australia, and got a chance to sit down with the co-CEO of Dimensional Fund Advisors. So that was our second episode where only one of us did the interview. The first one was you and Shane Parrish, and this was Dave and myself. Every other one we've done together. For those who don't know, Dimensional is an asset management company that creates portfolio solutions based on the kind of stuff that you talk about in your deep dives. Founded in 1983, they currently manage about 800 billion Canadian or so, and it's one of the great storied firms in this whole index fund revolution that's been happening for decades. Full transparency, we've been working with Dimensional, as people know, for client solutions since they came to Canada 20 years ago this fall. So you talk about time flying. It's unreal. Anyways, so with that set up, here's the quick review. So episode 43 from 2019 is a great place to learn about an important player in the index fund revolution, Dimensional Fund Advisors. What makes them particularly interesting is that they're at the intersection of some of the great academics of the past 50 years, along with the implementation of these great ideas. So Dave Butler, the co-CEO of Dimensional, has had a front row seat to this evolution over the past 25 years and has worked alongside such great people as David Booth, Eugene Fama, Rex Singfield, Mac McQuown, and of course Gerard O'Reilly, his co-CEO. But ideas without clients are of little value. So Dave's story is interesting in that he was part of a small determined team that brought this message to financial advisors. This is a whole new time for Dimensional, as they had only worked with institutions prior to then. So Dave was one of the first hires by Dan Wheeler, who we paid tribute to a few weeks ago. The interesting thread in this conversation with Dave is the company's concern and care for the ultimate client, the goal to improve the client investment experience, use research and technology to embrace indexing, then create products that investors can use in building portfolios. Anyways, the conversation was full of great stories, how he almost joined the NBA, to how his first interview with Dimensional ended up at lunch with Nobel laureate Merton Miller, which is just a terrific story. We talked about operating as a co-CEO, some lessons about leadership, and working alongside academic giants such as Fama and French. So such an interesting episode. And that was episode 43 with Dimensional Fund Advisors co-CEO Dave Butler. Okay, let's move to the book review section and try something different this week. Ben, if it's good with you. As listeners can imagine, learning is a big part of the life and culture here at PWL. So I thought for fun this week, we would invite our colleague, Lukas Fleck, to join us to participate in the book review and then to also talk about the 23 and 23 challenge. Lukas, so great to have you on the podcast.
Thanks for having me on. Long-time listener.
Excellent. Long-time listener, first-time visitor. So you joined the firm, Lukas, 5 years ago as an investment advisor based here in Ottawa, and you also recently became a CFA charter holder. Congratulations.
Thank you.
And you're also the coordinator of our company book club, which we'll talk more about later. But the book we wanted to review this week is the book that we discussed at our March book club. I'll let you cue it up.
For sure. So the book is The Obstacle is the Way by Ryan Holiday.
So how did we choose that book in the book club?
Yeah, so we operate sort of on a rotation basis for choosing books. It's a little bit random. This book was recommended to us by Tessa. She's our people and culture lead, and it was a great read.
And Tessa, I think many listeners know, is Ben's sister. Fantastic team member. Anyway, so we like to kick it off with a bit of background. So can you just share who Ryan Holiday is?
For sure. So Ryan's a writer, media strategist, and a best-selling author. He's best known for his books on Stoicism, primarily. So that includes this book, The Obstacle is the Way, also Ego is the Enemy, and The Daily Stoic. He's also got a website. It's called Meditations on Strategy and Life. This is what he's really sought out to do in his career, is write about things that he felt people don't talk about enough. So life, how to be self-critical, self-awareness, philosophy, and strategy.
So what was the basic premise, quickly, the basic premise of the book?
Yeah, so the book really is a formula or a headspace for overcoming really any negative situation that you might encounter in life. So the big takeaway is to thrive not just in spite of whatever happens, but because of whatever happens. So obstacles aren't something to be feared or avoided, but rather it's an opportunity to grow and become stronger. So our actions may and will be impeded by obstacles, but you can't impede our intentions. So we can always accommodate and adapt and overcome those impediments. And this impediment to action actually advances action. So in other words, what stands in the way becomes the way. And that was repeated a lot in the book.
I didn't realize this is the book we're going to be talking about. And it's funny because a really good friend of mine 2 weeks ago, it's actually the guy that people who have listened for a long time know that I went hiking in Newfoundland with. He was texting me that I have to read this book.
Wow.
It like changed his life, and that I absolutely have to read it. And it's like, all right, I'll read it. I haven't read it yet, but it's just kind of neat to see it come up here too.
Wow.
Cool.
Yeah, it was a cool book, and the topic really is what it's about. It's about using the obstacle to show you the way and to take that as a challenge, which is super interesting. But sorry, go ahead, Ben.
Yeah, well, what were your main takeaways from the book, Lucas?
Yeah, my main takeaways. The author really highlighted 3 key disciplines, and those 3 that he highlighted were perception, action, and the will. So perception is how we perceive a situation, and it shapes how we respond to it. We can't control what happens to us, but we can control how we respond. And so by choosing to see obstacles as opportunities for growth rather than just a negative thing in the way of where we're trying to get to, we can approach challenges with a much more positive attitude. And then actually overcoming those challenges obviously takes action, which is that second discipline. So we need to be willing to put in the work to actually overcome obstacles. And then the last one is will, which is the willingness to keep going and keep trying in the face of adversity. And sort of building off that discipline of will, the book made a couple key distinctions between perseverance and persistence that I found really interesting. So perseverance, that involves the willingness to adapt and change our strategy when we're faced with an obstacle. So it's realizing that the path isn't necessarily a straight line. Persistence, on the other hand, that's sort of trying something over and over, even when it's not working. And the author definitely portrayed perseverance in a much more positive light. Another cool takeaway, I thought, Cameron, I think you highlighted this, was that many of our problems actually come from having too much. So great times can be great softeners. Abundance can be its own obstacle. And so scarcity has bred some of the world's greatest ideas and innovations.
Mm-hmm.
And the author gave some really good concrete things to keep in mind when we're facing an obstacle. So I'll go through those, and that's to be objective, to control emotions, to keep an even keel, to choose to see the good in a situation, to steady our nerves, to ignore what disturbs or limits others, to place things into perspective, to revert to the present moment. And a big one is to focus on what can be controlled. So I really liked that sort of list of actionable items to keep in mind.
So as you think back on the book, did anything really particularly ring true to you?
Yeah, a big one for me is that perceptions are the problem. So when we're faced with an issue or an obstacle, it's easy to get tied up in emotions when really we should be dedicating that energy to actually solving the problem that's in front of us. So not wasting time on our emotions or perceptions and just focusing on the actual end goal and moving forward. And a huge one for me is focusing on what can be controlled. This is so applicable to all aspects of life, investment philosophies included. It's been a mantra that I've definitely lived with for the past little while, especially studying for exams. It's something that I had to keep telling myself is just focus on the inputs. That's all I can control is building good study habits, staying adamant about progressing towards that goal, and the output is just a byproduct of those inputs. So that really helped me. And a good line that I made note of was nice and simple, and it's listen to failure and learn from failures. That just kind of speaks to that notion of failing forward, always learning from mistakes or issues that you face. And I really like that.
The one line that jumped out at me that I've heard others say is, how you do anything is how you can do everything. And we can always do what's right. So love that line.
Yeah, I like that.
It's a pretty good line. So I guess I'm going to have to read this book now because it's coming at me from all angles. Was there anything, Lukas, that you didn't like about it?
There wasn't much that I didn't like about it. I really enjoyed the book. I think the one thing that I would tell people going in is that I wasn't wowed by any like sort of new novel ideas. I think the way that the author organized some of these thoughts was really good, and it solidified a lot of things that I think I've thought about a lot or that our team is already doing. So it was more of a book of like reiterating those good practices rather than sort of wowing me with a novel idea that I haven't thought of before. But I don't think there's an issue with that. I actually get a lot out of reading books that confirm habits that I've been doing. It's nice to have that confirmation, but I think just something to keep in mind. That was just my experience.
So what's your overall recommendation on the book?
I would recommend it for sure. It's a fairly quick read, and a lot of really good takeaways that I think are broadly applicable to life.
There you go, Ben. You are surrounded, so I guess you have to read it. So, Lukas, you're part of the 23 and 23 challenge, which people who are not part of that can join at rationalminder.ca. How far along are you towards the objective?
Yeah, so I'm about halfway through now. I think I'm working on books 12 and 13, so just over halfway. So I'm tracking well. For me, that's good. I know a lot of the guests who have been on here are probably through about 100 books this year, but I'm proud of what I've been able to do in my reading goals.
That's awesome. So what are your reading habits?
Yeah, so I mean, I'll start this off by saying that I by no means think that the way I do things is the best. Honestly, I've been constantly jumping around, changing my habits, trying to find what works for me. But I'm happy to share what I have found throughout that journey, and hopefully it's applicable to some people. So I only started reading more heavily about a year and a half ago. So, going through university, going through a lot of industry exams after the fact, that just became my excuse. I'm not saying it's a good excuse to not read for personal growth or for pleasure. And I was just so focused on getting through the technical side of my growth and knowledge that I didn't read a ton of books. And so I kept telling myself, as soon as I'm done this, I'm going to dive into it. And that reading list kept growing and growing. And I had a huge pile of books ready to go as soon as I was done. And so I started building that habit after I was done writing my CFA exam. And I found it very easy to build that habit and keep that habit. It's quite enjoyable. So I tend to have one text-based book, so that could be physical copy or Kindle on the go, and one audiobook on the go at all times. So I enjoy both differently. I go through audiobooks much quicker because I can mix it into my everyday routines. So if I'm walking my dog, shoveling, going to the gym, I can listen to an audiobook. I try to save books with a lot more data or diagrams for text. A good example of this is The Behavior Gap by Carl Richards. I read that earlier this year. And he has this amazing way of simplifying complex topics down to like a back of the napkin type drawing. And you'd just be missing so much of that book if you listen to it rather than reading it and actually seeing these diagrams. Mm-hmm. So I do try to select my books or how I read my books a little bit based on the content. But other than that, I just try to read every day, even if it's just 20 minutes. It's just like any habit. It's about repetition.
I remember after finishing the CFA exams feeling like I could learn anything.
I think that's part of it too, for sure. Because all of a sudden you have, all of your evenings are freed up to do whatever. And I'm used to sitting down and studying for hours on end. I was like, why not learn something else? And so, yeah, I've been enjoying just broadening that scope of knowledge.
Yeah, I remember that. It's like you build exercise the muscle of just sitting down and studying and learning stuff. And then CFA is gone. And it's like you have a gap to fill.
Yeah.
Kind of
And I don't know about you,
nice.
but I have that like paranoia of losing that skill. From
Yeah,
like,
yeah.
I just got to keep the momentum going.
Wow.
And like, it is nice to take breaks, but I think it's important to try to keep that momentum because it's not easy um, to pick up that skill and kind of force yourself back into the study regime.
Yeah, definitely. How do you capture stuff from what you read?
Yeah, I've tried a lot of different tactics because I've struggled with this for sure. But for audiobooks, I use Audible, and on Audible you can snip like clips of the book. So if I'm driving or something, like it's very easy to just take a quick snip, and then what I do, I just re-listen to those either when I'm done the book or through a large chunk of the book. I'll go back, listen to my snips, and just write them down into Notepad on my phone. I keep all those notes in a folder. I also use Readwise when I'm using Kindle. So I have the Kindle app on my phone and iPad, and I read off of that. And it's awesome because you can go through and review a bunch of your highlighted texts as like cue cards, sort of in random order. So you start picking up things that you read a year ago. And you're, oh yeah, I forgot about that. And then something I've recently started doing is, I don't know if this is a term, but retention journaling is what I'm calling it. Where I've heard that journaling is extremely important. I've never really tried it. So I thought, you know what, I'm just going to start writing down interesting things that I read or learned throughout the day. And it's not structured at all. I just sort of before bed, I try to download some interesting things that I either read, listened to, covered in a webinar, or just throughout a conversation I had with somebody. And it's been working well so far. Like I said, I just started it, so maybe I'll have to report back in a bit. But just trying to build that new habit and see how that goes.
So are these handwritten into a journal book or typed?
No, I'm typing them.
Okay.
I'm typing them on into Notepad on my phone. I just find my phone's always with me, so pretty easy to write stuff down.
So where do you get your reading ideas from?
Oh, that's the easy part, is finding books to read. My wish list is extremely long. I can't keep up with it. Coworkers, clients often have really good book recommendations, and it's great to read the same books as clients. It gives you something to, like, a common thing to talk about and discuss. And the podcast, obviously, I think probably most of the books that I read have either been discussed on the podcast, either prior to me reading it or after.
What are your favorite recent books that you've read?
I would say one that stood out to me was Deep Work by Cal Newport. That was an amazing read. It resonated with me a lot because as an advisor, your day-to-day can be quite hectic, and it's difficult. You actually have to go out of your way to create this deep work space and get focused work done. And that book gave me some really concrete takeaways to apply, and I have applied. So that was a great one. And probably recency bias, but the book I'm reading now, it's called Making Numbers Count. Both of these books have been reviewed on the podcast. So going back to where I find my book ideas from, I think this is making it pretty obvious. But Making Numbers Count is great for anybody that's trying to display information with numbers or tell stories with numbers. It's a really, really good book.
So you mentioned our book club, and you're the coordinator of our company book club. What tips might you have for others that might be thinking about a book club in their workplace?
Yeah, so I would highly recommend, do not overthink it. Don't over-engineer it. Just find some willing people, doesn't matter how many people, and just start discussing books. I think it's huge. Going back to how I capture ideas in action, I was like, talking about it with somebody is a really good way to solidify what I've learned from a book. And you get all these different opinions. People see things in different ways through a different lens. And it's so interesting to hear that. And Cameron, you're part of these discussions. Like, it's amazing the takeaways that we get from it and where the discussion goes. So I would also recommend, it's good to have a moderator in place, somebody that's ready to come to the meeting with questions and keep the discussion going. But just remember that the moderator's duty isn't to present. You don't want a slide deck and going through and reviewing a book like with a slide deck. I think the point of it is to discuss and get other people's thoughts.
I agree. And it always goes in a direction you kind of didn't see ahead of time. You learn a lot about your colleagues, and then we've done a lot of discussions during those times about applying what we learn to our day-to-day work lives. So it's a very productive use of time and a lot of fun, actually.
You guys are selling me on the book club. I haven't participated.
You should join. It's an open invite.
Open invite.
Lukas, you're known around the office with air quotes for people listening because we don't really go to the office anymore. But around PWL, for your life hacks, what reading hacks do you have to share?
Yeah, I knew this would come up. It's hard because reading isn't like often hacks are to kind of find shortcuts and cheat the system a little bit. And reading isn't really one of those things for me. Like one of the big benefits of reading is sort of the long form content. It's not something I'm looking to cut corners on. But that being said, I did think of a couple life hacks for reading. And one of them is, I think it's good to have a good book summary provider. So I use the app Headway. I have no idea if it's a good one or a bad one. It's just the first one I tried. It has been working for me. What this allows me to do is I can preview books before I read it. So you can get a quick 7-minute summary of a book before diving in and seeing if it's something you want to dedicate some more time to. But then I think even more importantly than this, after the fact, after I've read a book, it's really interesting to go back and re-listen to a summary, and it kind of brings you back into when you were reading the book. And it can be a book from a year ago, and you just remember a whole lot of details that you would have otherwise forgotten. And it's a little bit different than just taking notes, because when you take notes, you're highlighting what you think is important then. But in a year from now, you've gone through a lot of different experiences, and sometimes items that you didn't highlight now stand out. So I've been enjoying that. And there's also infographics for visual learners, so you can see like a book summary as like an infographic format, which I find really interesting. And then another quick little hack is for anybody using Audible, leverage your wish list. So if you add everything to your wish list, basically every month they release a couple included books, actually a lot of included books that are included in the subscription. So you don't need to go out and use a credit to pay for it. And if you have everything in your wish list, then you can see the little orange logo saying included. And often I've been surprised with how often something in my wish list is included that month. So if you're going through more than your 1 credit a month, it's a good way to move things up your reading list if it happens to be included.
That's really cool.
Yeah.
That's a good hack. Awesome. Lukas, great to have you on. Great to, I know you know a lot of the listeners, you meet a lot of people, but it's great to introduce you to the audience.
Yeah, thanks so much for having me.
Thanks, Lukas.
All right, Ben, out of 3 listeners and us that talk about the after show, you sent me a picture on the weekend of your new basketball hoop. You get the most unconventional, shall we say, and I love it. I haven't been there, but I've seen pictures of your setups. You got to tell.
Well, yeah, so people got a kick out of the fact that we had this gigantic trampoline in our house. So I had to get rid of that, unfortunately. Kids weren't too happy, but they'll be okay. But yeah, I got a regulation 10-foot basketball hoop up in the equivalent of our living room, I guess. It's not really a living room.
Now you have cement floors, so it bounces?
Yeah. Oh, yeah, yeah. Well, that's when we looked at this house. It's like, it's a bit sketchy. Like it was never finished completely. The parts that matter were finished, but like the interior finishes were never done. But when you walk in, it's the kind of main room in the house has a really high ceiling and a concrete floor. As soon as I saw it, I was like, oh my goodness, you could put a basketball hoop in there. And I've been dreaming about it ever since. So I did it.
Pretty cool. For those who watch Succession on HBO, I don't know, Ben, if you're a watcher or not, but the episode on Sunday, I'm not going to spoil anything. But if you're watching Succession and have not watched this week's episode, this will be last week when it's released, you got to watch it. Unbelievable. Okay, let's jump into this conversation about hot sauce. I got dragged into this. I'm in the crossfire of hot sauce with a bunch of our friends, a bunch of our FinTwit friends. Are you a big hot sauce guy, Ben?
I'm a big consumer of hot sauce, as is my wife.
Like, do you have preferred brands and
No.
Tabasco?
We have Tabasco in the fridge, yeah.
But you don't deem Tabasco to be your favorite?
No, it's definitely not my favorite.
Okay, so you're going to be against Mark McGrath and I. I never said for the record that it was my favorite. So Mark, who was our guest a month or so ago, was a big fan of Tabasco, put that on Twitter. And, of course, other friends of ours jumped all over him to say it's terrible. You should be trying these other sauces. And I jumped in saying, well, I kind of like it. I'm not saying it's the best, but I kind of like it. Anyways, it's the passion that people have around hot sauces makes the debate over the relevance of dividends seem mild, which is quite something. Anyways, they said, how could I stoop to such a level?
I like Tabasco. It's
So
part
do
of
I.
it's part of the rotation.
Anyways, well, Jason Pereira finds it completely unacceptable, Ben, that we actually have Tabasco in our fridge. I mean,
I'm sorry, Jason. The one that I just finished a bottle of some like really really hot ghost pepper hot sauce. It was incredible. I got a bottle at a farm store that I was at, and we finished it in like 3 days.
Did you have to sign, because the kids got me one for Christmas last year, they had to sign a waiver to buy it. It was so hot.
Yeah, no, it's not that kind of hot sauce. It was still very, very, very hot, but it wasn't the not the waiver kind.
Anyways, these guys even got a cameo done by Alton Brown, who I guess is a foodie on some food network. I don't know who he is, but I saw this video, and they've gone all to town. Anyways, so Mark and I are alone on one side, and we got Aaron and Aravind and Jason on the other side. So anyways, guys, it's a fun debate. So now I've been introduced to, Jason sent me a bunch of hot sauce providers here in Ottawa, so I'm going to check them out and try it out my hot sauce game.
Well, that's what I usually do. I usually get like one-off hot sauces that I find around. That's why I don't have a favorite. I don't have a favorite brand really. It's just try different hot sauces. I do like really really hot sauces though. Which Tabasco is not.
No, it's easy. Plus the bottles are so cute in your fridge. Like really, it's not that big a deal. Anyways, some recent reviews came in, which is very kind of people. So Growing the Valley podcast from the States said, my favorite personal finance podcast. Ben and Cameron have the perfect combination of investing nuts and bolts together with great social science findings, kind of like the Bogleheads on Investing and the Hidden Brain podcast had a baby. Super appreciate that they dig into the academic literature for us. Also enjoying the advanced basics episodes. Next one.
Tony Smiles from Canada. Don't know how you keep producing such quality content so regularly. The work that goes behind your podcast is monumental. It's superhuman. Keep it up. Very inspiring. I did almost die today trying to write the episode before we started recording, which is why I said a couple times that I hadn't seen it yet, because I was like head down writing for many hours before we started recording.
Nice feedback from Travis in Canada. Said this is a valuable addition to your week. I've enjoyed the podcast for a few months now. Ben Cameron and guests provide excellent financial and life advice. Already taken away a few life pearls and feeling rich. One of my takeaways, the ideal financial decision isn't always the best life decision. A better appreciation of the value of my time. For example, hired someone to install a new dishwasher this week rather than doing it myself. The cost is well worth it, and the time gained with my kids and lack of stress over doing something I'm not knowledgeable about. I reviewed the costs I pay for financial advice and will be making changes that should save me thousands of dollars over the years. I'm more aware of my own biases and how they influence my decision making. I'm contemplating a change in my work structure to make me more time rich as opposed to money rich. There hasn't been another podcast so applicable to my daily life. Thanks, guys, and please keep up the good work. P.S. My son has a worm farm. We've been using it for fishing bait, and I've been inspired now to use it to help teach him some business and financial lessons. Very kind of Travis. Thank you.
Very nice. Alpo 100 from the United States says that it's an incredible resource for the financially curious. Cameron and Ben do a phenomenal job taking the leading thinking in finance and distilling the information to something palatable for anyone curious about money. Thank you both.
Chris reached out on LinkedIn and asked if we're going to be doing a meetup at the IAFP conference in Edmonton in September. I can't make it. Are you going, Ben? Do you know?
Well, we're going to be in Toronto, you and I. That's going to overlap with that. So if I am going to go, it's going to be like from Toronto to there. So I'm undecided. Yeah, but if I go, we can do a meetup, sure.
Okay,
as long as there are snacks. I only go to meetups with snacks.
We can make sure there's snacks. And speaking of events and meetups, if anyone's going to the IWI ACE Academy in San Diego in a few weeks, I'm going to be there if you want to meet up. If you're going to Future Proof Festival in September in Huntington Beach, we will be there. We're doing a live recording and thinking about hosting a Canadian breakfast for fellow Canadian advisors. So you can reach out to info@rationalreminder.ca. Also thinking about a meetup in the LA area on Saturday night, September 9th, and also in Toronto on September 20th. And I'm kicking around the idea of going to Chicago this summer, so might do a meetup in Chicago. If anyone's interested, you can reach out. In the store, we've had almost 800 orders in the store.
Like in total forever?
Yeah, in total forever. Only been doing it a couple of years, right? But summertime is koozie time. Yes, your favorite word, Ben, koozies. You get a free koozie and a free pair of socks. So buy a hoodie. They're super soft, super comfortable. So you buy a hoodie for $45, and if you're in North America, you get free shipping and socks and a koozie. So again, that's all on rationalreminder.ca site. So you can go there, shop, join the challenge.
Can I ask you, why do we have the store? Because we don't make money off of it. Is it just fun?
Oh, no, we actually lose money off it, Ben, just to be clear. It's just fun to get the merch out there and get retweets. No, we don't make money. We lose money in every order. And then when I go and get motivated and do my giveaways, which gets everyone inspired, like we're shipping like $8 socks with free koozies across the continent for free, and you get whatever we did. So,
like, do you get joy out of knowing people are wearing Rational Reminder swag?
I do.
It's cool.
It's cool. Love connecting with people, so reach out on all the different platforms. If I said this a couple weeks ago, if you're a financial advisor in Canada and are considering options for the succession of your practice, please reach out. As we said earlier, next week's guest, incredible, Professor Campbell. Also coming up in a few weeks will be our conversation with Burton Malkiel, author of A Random Walk Down Wall Street, which just released its 50th anniversary edition. It's phenomenal. I'm halfway through it now. So we want to get a head start on that. We got lots of books coming up. We got Nick Majuli coming up, Just Keep Buying. Robin Powell and his co-author coming up. Jill Schlesinger just released a book. She's coming up also. So got a lot of good books coming up.
So this is a new thing we're doing now. It's like a new segment. You kind of briefly mentioned it last time we did an episode, but I don't know if we've...
Well, it's part of Advanced Basics, right? So we're going to be doing more books on the financial basics. Having the authors on to talk about their book, and we'll talk about their reading habits as well, so kind of put it all together. Anything else this week, Ben?
Yeah, I wanted to leave something at the end here. I don't know if we'll be able to show the video or not because it's not ours, but the AMF in Quebec, which is like the securities regulator in Quebec. Do you know what does the AMF stand for?
Autorité des marchés financiers, I believe.
Yeah, I knew that too, but I can't say it as well as you. Not that you did it very well, but I would have been worse. They have these ads that I see on Reddit, and I think that they're so funny. So I'll describe it, but if we can show like a clip of it, that would be even better. So they have videos of ridiculous activities. Like they have one of a woman trying to walk over like an icy river and falling on her face. And they have one of a guy doing a jump on a bike over like a piece of plywood, trying to jump over 4 of his friends. And they have these just ridiculous things happening. And then they say, see the risk? It's just as obvious with crypto. It's just hilarious. And then they're trying to protect consumers in Quebec from crypto. But I haven't seen protection that overt from other regulators.
And this is a recent series of ads?
Fairly recent, yeah. I've only noticed it for the last couple of weeks, probably. I don't know when they started. But
So you
they're
don't
posting them on Reddit as promoted posts. It's just
but you don't know if they were out there at the peak of the crypto craze last year.
Yeah, no, I don't know that. Yeah, too late maybe. But better late than never, maybe.
I guess.
They're in French too. So they don't probably appeal to everybody. I live in Quebec, so I get them
In French.
in French.
Cool.
Yeah.
All right. Anything else?
No, that's it.
All right, everybody. Thanks for listening.